In this video, I'll be going over my top 7 stocks for the month of May 2022. Over the last month, I've analyzed hundreds of companies and compiled a list of stocks that I believe should be on your radar. I strongly advise you stay tuned until the end to hear my complete analysis on each of these stocks. I'll go through some major metrics from recent news and why I think they'll continue to rise. Let's get started. But before we begin, make sure to keep yourself informed and engaged by subscribing to the channel, clicking the notification bell, and turning on all notifications so you won't miss our latest uploads. The first stock we're talking about today is Twitter, ticker symbol TWTR. Twitter is a popular American social media platform that most of you have probably heard of recently. Twitter's stock is currently trading at $49.02 per share, with a 52-week low of $31.03 and a 52-week high of $73.34. Looking at their one-year price history, you can see that they were trading at over $70 a share a year ago, experienced a major collapse around the end of April 2021, hit a low in the upper 30s, and are currently somewhat higher. They currently have a market capitalization of $37.431 billion and a loss of 28 cents per share. The current price-to-book ratio is 5.11, while the current price-to-sales ratio is 7.69. They have a negative profit margin, with a current profit margin of negative 4.36% and a negative return equity of negative 2.9%, as we observed earlier. This is based on $5.08 billion in revenue during the last 12 months. They have $6.39 billion in cash on hand and a current ratio of 5.89, which is extremely high. Analysts have given Twitter a 2.9 on the scale of 1 to 5, with 1 being a strong buy and 5 being a sell. And the average analyst price target is currently $51, up 4% from the current price of $49.02. So the big news about Twitter is that Elon Musk is negotiating a deal to buy the world's most popular social media network for $44 billion. Also praising the purchase is former Twitter CEO Jack Dorsey, who says, quote, "Elon is the sole solution I trust." Despite the fact that there's no assurance that this acquisition would be completed and the reality that it could take a long time before this deal could actually go through, there's still a lot of buzz and speculation driving the stock's valuation and interest. If the plan is fully implemented, Twitter will become private, which means it will no longer be listed on the New York Stock Exchange. This could explain Twitter's recent bearish price action, since shareholders are not likely delighted about one of the world's largest corporations turning private. However, one could argue that Elon's purchase is quite optimistic for the stock. Musk proposed purchasing Twitter for $54.20 per share, totaling $44 billion. The trouble is, right now, Twitter is trading for less than $50 per share, and owing to all the hype and publicity, that number could change very quickly. Twitter has released its financial report for the first quarter of 2022, and we can see that several of the indicators failed analysis expectations. Twitter, for example, generated revenue of $1.2 billion when analysts expected $1.3 billion. However, there were plenty of year-over-year growth for Twitter, so it's not likely that the firm is losing money. It simply isn't performing as well as analysts expected. Finally, I believe that this purchase will result in a great short-term momentum play, as investors want to get in early and profit before the company's value falls before Musk's offer price. For the next few days or months, I'll surely be watching Twitter. Yes, this is a high-risk investment, but I wanted to discuss Twitter because they're in the news right now, and the stock is fluctuating a lot. Perhaps not the ideal investment for long-term investors. The second stock we're talking about today is Microsoft, ticker MSFT. Microsoft is an American technology corporation that makes computers and software. As a result, one share of the firm is currently trading for $277.52, with a 52-week low of $238.07 and a 52-week high of $349.67. Looking at the one-year price chart, we can see some significant gains for the last year all the way up to November and December, which is to be expected given how badly tech is performing right now. At the current value, they have a market cap of $2.076 trillion, a PE ratio of 29.56, earnings per share of $9.39, and they pay a modest dividend of 0.86%. They have a price-to-book ratio of 12.66 and a 5-year projected PEG ratio of 1.85. They have a 38.5% profit margin and a 49.05% return equity, all of which are excellent. In the last 12 months, revenues totaled $184.9 billion. On their balance sheet, they have $125.35 billion in cash and a current ratio of 2.25. Analysts adore Microsoft, giving it a 1.7 rating, and the average analyst price target is $364.65, which is almost 25% higher than the current price of $277.52. So, on April 26, Microsoft released its earnings, and it had a lot of good financial news to give. To begin, the tech giant made revenue of $49.4 billion, an increase of 18% year over year, and the company's operational income was $20.4 billion, up 19% from the previous year. The market responded well to this performance. This is in stark contrast to the performance of Microsoft and other big market stocks over the last month. Indeed, predictions of an economic slowdown have lowered the value of the stock market as a whole. Consumers and investors are fearful of the Federal Reserve raising interest rates, and as a result, the price of Microsoft and other big tech firms has all fallen in line with this pessimistic trend. As a result, it's likely that big tech is undervalued for some specific companies right now. And based on its most recent earnings report, I believe that predictions of an economic slowdown don't change the fact that Microsoft, one of the world's largest and most durable firms, is making remarkably massive profits. I just think Microsoft, along with firms like Apple, is a great long-term investment, and the fact that its price is being driven down more than anything else by investor anxieties and concerns could indicate that the company's value has a lot more opportunity to increase. This potential growth also suggests that investors who are ready to stick it out for Microsoft for the long haul could profit. Overall, I'm constantly dollar cost averaging Microsoft stock, and I think you should have it on your watch list as well. AT&T, stock ticker T, comes in third in our list. They're an American telecommunications business that also happens to be one of the world's largest. One share of AT&T is currently trading at $18.86, with a 52-week low of $16.63 and a 52-week high of $25.59. Looking at the one-year price chart, we can see that AT&T's price has dropped significantly in the recent year. We began trading around $21 per share a year ago, soared to over $24 per share, and then fell to lows of under $16 per share. Since then, it has fluctuated between $16 and $21 per share. They have a market capitalization of $135.019 billion, a PDE ratio of 6.82, earnings per share of $2.76, and a 5.72% dividend. They are likely to be pegged for 5 years. With a price-to-book ratio of 0.83, the ratio is 2.6. Their profit margin is 11.89%, and they have 11.83% return equity. This is based on revenues of $168.86 billion in the previous year, and its balance sheet shows total cash of $21.21 billion and a current ratio of 0.7. They have more current liabilities than current assets, which is problematic. Analysts have given them a 2.6 rating, indicating that they are somewhere between a buy and a hold. And the average analyst price objective is $24.64, or around 30 cents higher than the current price of 86 cents. So, on April 21st, AT&T reported its earnings, stating that its diluted earnings per share were 65 cents, compared to $1.02 a year ago, and that its adjusted earnings per share were 77 cents compared to 85 cents a year ago. Although these figures aren't ideal, AT&T CEO John Sankey stated in the same financial report that the company's postpaid phone net commercials, as well as fiber broadband net ads, have been quite successful. I think it's crucial to remember that the telecom company only hired Sankey as its CEO 2 years ago. Thus, the past few years have been more of a transition for the company than normal business. With Sankey in charge, one of the greatest adjustments the business wants is to focus less on the entertainment empire that AT&T has spent billions to establish. Instead, the company wants to devote more time and money to its 5G incorporation, which is arguably one of its most promising business prospects. This is why, just in the month of April, AT&T released important news about the demise of its Warner Media company. The telecom business in particular reported that the merger of Warner Media and Discovery has been completed. As a result, Warner Media received $40.4 billion in cash, effectively removing much of the debt it had when it was still a part of AT&T's network of assets. And a company's asset pool is usually something that makes me optimistic about it, to give back to its shareholders as seen by its dividend yield. They pay a hefty yearly dividend of 11 cents per share, which corresponds to a 5.82% return as we discussed. So, even if the company has a few quarters of lower profitability, the fact that it can still return cash to investors shows that AT&T is still a strong, long-lasting company with enough cash to pay out shareholders. Up next is Western Digital Corp, stock ticker WDC. Western Digital is an American hard disk drive manufacturer known for its design, development, and selling of data technology products. One share of WDC is currently trading at $53.75 with a 52-week low of $43.85 and a 52-week high of $78.19. Here's a one-year price chart. You can see that they were trading between $65 and $75 a share a year ago, and starting in June of 2021 we saw a pretty significant decrease, which has continued since. They have a market cap of $16.607 billion, a PE ratio of 8.36, and earnings per share of $6.35. We have a price-to-book ratio of 1.29 and a 5-year project PEG ratio of 0.33. They have a profit margin of 10.52% and an excellent return on equity of 18.25%. They had revenues of $18.94 billion in the previous year, and they presently have a total cash of $2.53 billion with a current ratio of 1.93. Analysts love WDC, giving it a 2, indicating that it's currently a buy. As you may have noticed, the end of April is a busy time of year for many organizations, including Western Digital Corp. The IT business recently released its earnings for the third fiscal year of 2022, and it has a lot of good news to share with its stockholders. More specifically, WDC's sales increased by 6% year over year to $4.38 billion, including a 25% increase in cloud revenue. WDC consistently outperforms analyst estimates, which is typically a positive sign for a company's future growth. Western Digital is also demonstrating the power of its commercial relationships and alliances. More precisely, the company announced a joint investment in a new production facility in Japan with Kioxia, a flash memory and SSD manufacturer. This collaboration is another important milestone in the two companies' strategic joint venture engagement, which has lasted 2 decades. This transaction also demonstrates that Western Digital Corp is financially stable enough to invest in new properties and assets. This isn't the only large-scale collaboration Western Digital has undertaken. WDC recently formed a cooperation with Samsung to accelerate the adoption of next-generation data placement, processing, and fabric storage technologies. The development and implementation of these new technologies will enable organizations to have better data storage options, hence increasing client adoption. Finally, WDC has been existing for a long time, and its solid financial success, as well as important connections with other firms, continue to be positive factors. For this reason, I believe WDC is a stock worth keeping an eye on for a long time. McDonald's, stock ticker MCD, is next on our stock list. You're all familiar with McDonald's, an American global fast food chain and restaurant that is one of the world's largest and most successful food and real estate businesses. So, one share of McDonald's is currently trading at $249.16, with a 52-week low of $217.68 and a 52-week high of $271.15. Here's a one-year price chart. You can see that they were trading at roughly $210 a share a year ago, progressively grew in price to the one-year high, saw a significant downturn, and have just recovered. They have a market cap of $184.28 billion, a PE ratio of 24.82, earnings per share of $10.04, and a tiny dividend of 2%. They have a profit margin of 32.49% and a 5-year projected PEG ratio of 3.22. According to their income statement, they had revenues of $23.22 billion in the previous year, and their balance sheet reveals that they had total cash of $4.71 billion and a current ratio of 1.78. McDonald's has a 2.1 analyst rating, indicating that it is a buy, and the average analyst price target is $280.79, up over 10% from the current price of $249.16. McDonald's was another company with a strong earnings report this season, announcing that the global comparable sales grew over 12%, digital sales exceeding $5 billion, and same-store sales in the United States increased by 3.5%. Although pricing increases in the United States boosted these figures, its earnings report nevertheless outperformed Wall Street expectations. One thing that strikes me as particularly impressive about McDonald's is that they are still generally profitable despite the Russia-Ukraine conflict, which is incredible given that the conflict is costing the fast food giant well over $100 million in quarterly earnings. This merely goes to illustrate how very sturdy and reliable McDonald's is. We shouldn't be surprised though, because we all know McDonald's and how well known and timeless it is. In fact, they are so reliable that corporations that collaborate with them will seek significant stock market gains. Beyond Meat stock, for example, has risen in value in anticipation of a long-term cooperation with McDonald's. Another encouraging announcement is that McDonald's is still aware of and proactive in upgrading and enhancing its many services for its consumers. Their restaurants in Japan in particular have just added 3 new dessert products to their menu: a green tea McShake, a new mochi pie, and a soft-serve ice cream with banana custard and nuts. McDonald's is unique in that it has multiple locations in the world, each catering to a different consumer base. As a result, you have a continually changing and refreshing menu that makes McDonald's one of the most exciting places to eat in the world. McDonald's has been there for a long time without slowing down, and I don't see it slowing down anytime soon, which is why I believe it should be on your watch list this month. Raytheon Technologies Corp., stock ticker RTX, is number 6 on our list. Raytheon is an American aerospace and defense firm that is one of the world's major providers of aerospace intelligence and defense. One share is currently trading at $94.91, with a 52-week low of $79 and a high of $106.02. On the basis of the price chart, this is one of the stocks that goes against the trend. They have risen in value over the last year and now have a market capitalization of $141.152 billion, a PE ratio of 37.1, profits per share of $2.56, and a tiny dividend of 2.24%. They have a price-to-book ratio of 2.02 and a 5-year project PEG ratio of 1.72. They currently have a profit margin of 6% and a return on equity of 5.58%. The company generated $64.39 billion in sales in the previous year, and it currently has $7.83 billion in cash and a current ratio of 1.19. Raytheon is rated a 1.2 by experts, indicating that it is a buy. The average analyst price target is $114.76, which is roughly 20% higher than the current price of $94.91. So, on April 26th, Raytheon announced profits, reporting total net sales of $15.7 billion, up 3% year over year. In addition, the corporation recorded an increase in net income year over year, relative stability in assets and shareholder equity, and a decrease in total liabilities. To summarize, Raytheon has a strong fiscal quarter, which should be taken into account when analyzing how the aerospace firm is faring in light of recent developments. It's no surprise that the Russian-Ukraine conflict has impacted Raytheon. Due to a scarcity of materials for weapons that Western allies have rushed to Ukraine, according to CEO Greg Hayes, the corporation will not be able to increase manufacturing of Stinger missiles until 2023. In reality, the corporation cut its revenue forecast for the year by $750 million, owing to the crisis, forcing it to take its commercial aircraft operations out of Russia. As a result, it's not surprising that Raytheon's sales and profitability will take a blow in the short term. However, as pro-Ukraine Western countries restock their missile supply, Raytheon predicts a surge in sales, implying more consumers for the company. Raytheon, I feel, is a good long-term investment since it's facing a short-term drop in value that functions as a discount for almost certain price increase down the road. Raytheon's defense division will also play a key role in streamlining and benefiting the company's commercial aerospace endeavor. The goal is to get back to pre-pandemic levels of activity and profitability, and as the pandemic fades away, we may expect to see an uptick in air travel. Long-term shareholders can anticipate Raytheon to find a means to acquire assets so that it can redirect its resources and attention away from defense. Overall, this is a good stock that you should look into for the month of May 2022. The Vanguard Total Stock Market Index Fund ETF, stock ticker VTI, is the last one on our list. The CRSP US Total Market Index is tracked by VTI, which is an exchange-traded fund. So it's not a single company, but rather an exchange-traded fund that includes a number of them. One share of VTI is now trading at $206.88, with a 52-week low of $206.71 and a high of $244.06. We are quite close to the one-year bottom according to the one-year price chart. The previous year was fantastic for VTI, right up at the beginning of 2020 when we witnessed some significant corrections. This fund's total net assets are $1.31 trillion, with an average yield of 1.26%. The year-to-date daily total return is negative 13.04%, with a 0.03% expenditure ratio. They're classified as a large blend fund having an average price-to-earnings ratio of 25.59 and a price-to-book ratio of 4.18%. Looking at the winning sectors, we can find the consumer cyclical is over 11%, financial services is over 13%, healthcare is over 13%, and technology over 25.05%. Apple, Microsoft, Amazon, Facebook, ABC, Tesla, Berkshire Hathaway, Nvidia, and JP Morgan Chase are among the fund's top 10 holdings. The 3-year daily total return is 13.48%, whereas the 1-year daily total return is negative 7%. If we look at an annual total return percent history, we can see that we have been in the green for the most of the years, with the exception of 2018, 2008, and 2002. VTI's volatility will likely be higher than some other ETFs that focus on large size or blue chip firms, since it places a large emphasis on diversifying its portfolio to small and mid-cap stocks. Specifically, the ETF holds over 4,000 different companies, many of which are smaller enterprises with more erratic price changes. So one of the things that I admire about VTI is that it embraces the idea of buying as much of the market as possible rather than cherry-picking individual jewels. This concept of buying the whole haystack rather than just the needles in the haystack allows investors to acquire more market exposure. Therefore, VTI could be the appropriate investment for those looking to profit from as much of the market as possible. I'm also optimistic about the US stock market as a whole because public sentiment has significantly lowered market prices. The increase in interest rates is consumers' top concern, and this negative feeling has made many people apprehensive or dubious of investing in huge tech businesses or growth stocks. The war also had a negative impact on global industry and has lowered the value of numerous stocks. I believe that the market will recover at some point, and that what is happening now is that many valuable companies are being sold at a discount. The ETF, which spreads exposure to hundreds of companies in the market, offers a lot of safety and opportunity. I truly believe that VTI is a good long-term investment, and current events have created a once-in-a-lifetime opportunity to invest while the price is cheap. So, if you're looking for a more secure and likely more passive investment, VTI is a great option. In any case, these are my best stocks for May 2022. Happy trading, and if you liked the video, please share it with a friend, and please remember to like, share, and subscribe. See you guys in the next one, and remember, keep living life bullish.